It took me a minute to find the link, the Zoom link. So I was like a
Happens
minute.
to me every week. I'm
Yeah.
the same. Well, good to see you. I'm going to do a quick introduction and we'll get the recording going and I'll turn it over to you. Does that sound all right?
Yeah, that sounds great. Thanks.
Great. Rachel, you ready?
Let's do it.
Hey guys, Brian Schroeder here with Buyers Club. We do Buyers Club live every Wednesday at noon. So excited to see so many of you here today. Today we got an exciting call. We got Peyton Gillis on the line. Peyton is a CPA and really a tax expert and an expert in real estate investors, helping real estate investors save on their taxes. And I guess it was what, 2 weeks ago or so, the new tax bill, well, the big beautiful bill got passed, which I don't know, I call it a tax bill, but it was a lot more than a tax bill. But what we're going to be talking about today is the tax issues or benefits or whatever for real estate investors that came out of that tax bill. So super excited to see what Peyton has to say. Honestly, I haven't followed it much. I know that it extended the tax cuts from like 2017, but I don't really know any of the details that came out of it. So I'm excited to learn here today from Peyton. And any of you guys that are on the call today, I would love it if you could turn your video on. Most of you guys do already have your video on, which is awesome. I just love being able to participate and see you guys' faces and stuff. And I think it's good for Peyton to see you guys too. So I appreciate you doing that if you can, if you're driving, I understand. Good to see everybody today. Peyton, I'm going to turn it over to you, and you can kind of like guide. Do you want people to ask questions throughout, or you want to just kind of have people wait to the end? Whatever you prefer. We can take it whichever way you want.
Yeah. I mean, feel free to jump in and ask questions at any point. One thing I'll tell you with this is there's a lot in this bill. I mean, I've been on about 8 to 10 hours of webinars so far, learning on it and stuff. But so if you bring me something that may be in the bill, I can talk about it, but it might also be like, hey, we've got to get more into this because again, it's pretty fresh, as Brian said, 2 to 3 weeks. The bill passed, and then what happens is a lot of times within these bills, a lot of stuff takes clarification. And so they pass the bill, accountants and everyone's like, hey, what's this mean? What's this mean? What's this mean? All the clients ask us, hey, what's this mean? What's this mean? We have to go to the IRS, and then the IRS will put out more correspondence for it. Like, this is exactly what we mean. Like, this is really what we mean by no overtime and tips. So I'll go through any of that, or if there's anything that's not in here that's in the bill, feel free to bring it up or a question about it. Just know that I might kind of either tell you, hey, it's a little out of the scope, or we will, feel free to reach out type of a thing. So it's a pretty expansive bill, as Brian said.
Cool. Let's dive in.
Okay, cool. Well, I shared the slides here. I'm going to share my screen, but if anyone wants to follow along, those are in the chat, where you can just save them after too. So let me share my screen. Just start this, like that little, got a PowerPoint here that I can go to with it.
Thanks for sharing your slides there, man. I appreciate it. I downloaded it on my computer. So if anybody else wants to do that.
I'm trying to get them up and just share along for anyone who's not able to bring them up. I'll just share and then see if I can get the presentation up. Here are the slides. Can everyone see this? The slides here.
Yep, I can see it.
Try to get them into bigger mode, but I think it's still giving you guys the display. All right, can everyone see them okay at least?
Yeah.
Okay.
You can change the display settings up top, Peyton, if you feel like it.
Okay, let's see. Display swap. There we go. All right, that's what I was trying to do. I have two monitors, so now is the big one on the right screen that you guys can see. Okay. All right, so on the one big beautiful bill act, so it's a mouthful. So you might hear it called the OBB, the OBBA, the OB3, but it's really an expansive act. There's a lot included in there. I'll tell you just some general notes on it. Anything that Trump promised through his campaign it probably got in for the term of his presidency. So if it was no tax on tips, if it was no tax on overtime, that kind of stuff, a lot of that they got in through 2028. A lot of the other things in there that weren't necessarily campaign promises, such as extensions of bonus depreciation and things like that, that got in either for longer periods or permanently. So that's just kind of a high level note overall. So a lot of the things that he wanted in it or had promised that he could get in it, they did get in temporarily. And then a lot of the other stuff got in more permanently or longer term. So that's just kind of a quick note on the bill and kind of a way to wrap your head around anything. If you hear about it, you'll be like, oh yeah, that was more of a campaign promise. I bet that's limited in the time frame. So so what I'm going to talk really are the ones, kind of the way I've ordered them here are the ones that I think, in order that they probably affect most people on our call here. And so obviously real estate, anything that's touching the real estate investment world at all, those are the big ones. So permanent bonus, QBI deduction, and then the state and local tax limits and the pass-through entity tax credits. Those are the three big ones I know probably are going to affect a lot of real estate people regardless. There's some other quick items I'll go through on those. And then if we have time, I'll go through some of the other items, or if these pertain to you guys and you want to jump in, other items of note, maybe wait till we get through the top ones and then jump in. If you're like, what about, I'm a bartender on the side or whatever I do, or, hey, there's no tax on tips. What's that mean if I'm in this industry or overtime stuff? There's some other like little stuffs in there that we'll touch base if we have time. So the big one for all real estate investors, and that really everyone on this call should understand, is 100% bonus depreciation has been restored and it's now permanent. So in all my time as an accountant, and even at any point that bonus depreciation has been out there, it's never been permanent. It's always been a temporary thing. So this is the first time it's ever been permanent. And 100% is it, the only other real time that it was 100% was in the TCJA Act from 2018 to 2022. So this is a pretty big deal for business owners and real estate investors. And so what it really breaks down to is, first, the 4 steps I kind of go through it in is you have to understand depreciation, which is when you go buy, depreciation is on rental properties, it's on fixed assets. It's not on your flips. So flips work entirely differently. This will be for real estate investors. This is on either your long-term buy and holds, your short-term, your midterms. These are your buy and holds. On those properties, you can take, if you buy the property for, let's say, $500,000, a portion's going to go to land, maybe $100,000, and $400,000 is going to go to building. Land will not be depreciated, but the building will be depreciated. So you don't get to take all $400,000 in year 1 as a deduction. Instead, you divide it over 27 and a half years, and you deduct it a little bit each year for 27 and a half years. So that's just regular depreciation. It works the same if you get, you go buy a new business vehicle or a tractor or a piece of equipment or flooring, something big, something over $2,500 that has a life of more than a year. Like, that's generally how depreciation works. Everything that you go buy like that, everything that's big, it has a lifespan. They say, hey, you can't take it all up front. Instead, divide it over that lifespan. So if you go get flooring and it costs $10,000, it's a 5-year lifespan. Instead of taking $10,000, they want you to divide 10,000 by 5 and take $2,500 a year as your expense for it. So that's how just basic straight line depreciation works. The good news in real estate is it's really the only place. The reason this rule exists for depreciation is that in general, when you buy equipment, when you buy vehicles, things do depreciate in an economic sense. So most things go down in value over time. So that's why they allow for depreciation, because if you buy a vehicle over time, if you bought it for 60 grand, it goes down 10 grand a year. When you go sell it in 3 years, they're trying to match up that if you sell it for 30,000 on your books, it's worth 30,000. It's never going to be perfect, but in general, that vehicle goes down each year. The thing with real estate is, historically, over time, real estate appreciates. So even though you're getting a deduction for this every year because the IRS views it as an asset that goes down in value, in reality, in the real economic sense, it's likely going up in value over time when you look at it from a grand scale, right? So that's really how depreciation works, and it's why it's so powerful in the real estate world, is because you're getting kind of this free loan from the government to get these deductions while your property is actually going up in value. And then there's all kinds of creative ways to kick the can down the road on capital gains and depreciation recapture and things like that. So when you take that into the account with the time value money, that's the power of depreciation. Where bonus depreciation comes in is bonus allows you to say, hey, wait, we don't want to take that $10,000 flooring and divide it by 5 years. We want a big portion of it up front. And that's bonus depreciation. So it's an incentive that since 2002, 2003 has been, the government has allowed for businesses to write things off faster. So if you bought that car for $60,000 in the business, it's going to say, okay, you can take 50% of that right away. So maybe you can take $30,000 right away, and then the rest of the 30 divided over 5 years. Or you can take 60% of it right away, whatever percentage they want to give it. Well, it's back to 100%, meaning if you buy that $60,000 vehicle, you can take $60,000 right away if it's all business use, right? So like it's back to 100%. That's what the 100% bonus means. And the fact that it's permanent is huge. With the TCJA that passed, it was temporary from 2018 to 22, it was 100%. So if you bought your property, got it in service in those years, great. But if you got it in 23, it went to 80%. In 24, it went to 60%. In 25, it had went to 40%. So, and then it was set to dwindle out and go away. So the fact that it comes back and it's 100%, it really can't be overstated as far as the bill goes for a real estate investor or a business owner. So I'm gonna run through a case study kind of on this for you guys so you can see how it can work. Because there's the biggest piece to this is any building, any 27.5 year, or if it's a short term or a commercial building, it's 39-year property. Any of those, you cannot directly take bonus depreciation on. So if you got your $500,000 property, 100's land, 400's building, you can't just take 100% of the 400. They're still going to say you can never take bonus on that. It has to be divided over 27.5 years. And that's where cost segregations come in. So for real estate, if you want bonus depreciation on the actual purchase price of the building, 9 times out of 10, if you want that and it's beneficial to you, you need to get a cost segregation study done. Whether it's residential, commercial, short-term, you would need a cost segregation. And what the cost segregation study does is it comes in and it says, hey, this place that they paid $500,000 for, they didn't pay $500,000 in 100 for land and 400 for the building. They really paid, a portion of money was for things that are inside that building: flooring, cabinets, fans, sidewalks, driveways outside, backyard fence, like all this other stuff. And because of that, you now get a report that tells you, here's the breakdown. It's not 400 building, 100 land. It's 100 to 5-year properties. So things like that, like the cabinets, it'll break it all down to a T, but they'll say 5-year, 7-year, 15 property. Then maybe 300 is the building and 100 is the land. Well, then the engineers give us that report from the cost segregation study. Then as the accountants, I can take that report and I now have something that tells me, hey, 100,000 of this, I can take 100% of it right away, because they broke it out away from the building into 5 or 7 or 15-year property, furniture, equipment, things like that, that bonus depreciation is allowed on. So it's huge savings there. Now the cost segregations, those cost money. On a residential, if you're below, I usually tell people, think of if your purchase price and renovations is 150 plus, really 150 to 750. You're probably talking about a cost segregation at a paper study level or an engineering study level, which should run you somewhere between, I don't know, $1,500, $1,000, $1,500 to $5,000, just depending on the level. If you've got something beyond that, like a commercial property, a bigger Airbnb, a couple $1 million, like you're going to need the engineering firm to come in person and do that study. And you're probably talking about $5,000 to $15,000 on the study. So you need a place and you need enough tax savings from this, and you need to be able to use the tax savings to justify the cost of the cost segregation study. Okay, so I'm going to go through kind of an example here to kind of help explain it on this. So in this, it's 100% bonus, and I'm going to compare it to where it was. It was at 40% until they did this. So when they put it back in, 100% is effective for any properties placed in service January 19th, 2025. Why January 19th? Anyone got the date? It's Inauguration Day.
Biden did not get 1 day of credit.
Yeah. So Inauguration Day. So
Is that it? They didn't want to give Biden any a day of credit?
Yeah.
That's good, Greg.
That's funny. So Inauguration Day. So what's weird this year is if you put a property in service from January 1st to January 19th, you are in a really bad spot. You're at 40% bonus if you're in that range. So that's rough, or an asset during that period of January 1st to January 19th. If the property was in place before that, or the equipment asset was in place before that, you're at 60% in 24, 80% in 23, and 100% before that. But if it's after January 19th, it's 100% depreciation. So if we look in this example, here's what it would have looked like with 40%, and here's what it would have looked like with 100%. So we're going to say on July 1st, you went and bought a property for $750, and we allocated the land was $150 and the building was $600.
I don't have the full text of the big beautiful bill to read.
Okay, and then so what happens is now you go get a cost segregation done on this. In general, the cost segregation, back of the napkin math, let's just say it breaks out 25% of the building cost. So it breaks out another $150. So with the cost segregation, it now looks like I've got a building of $450, land of $150, and 5, 7, 15-year assets of $150. When we were at 40% depreciation, you could have taken 40% of this $150 right away. So you could have taken $60,000 right away, and then what's left, the building and everything else, like you can divide over the life of it. So you would have got probably another like $12,000 in year 1. Year 2, you'd probably get about $20,000, and then each year you'd get a little bit. So year 1, you'd get $72,000. If we assume you're at a 25% tax rate between federal and state, in Missouri, the state follows federal, so you get bonus for state too. You would have saved $18,000 in tax on this property just from the depreciation. So it's not bad. You would have saved $18,000 in year 1. But with it going to 100%, you're going to get all $150 right away. So you get $150 right away, plus what's left of the $450,000 building, you get to divide over the 27.5 years. So you get you get a half year of that, you get another $8,000 or so. So total now your depreciation expense isn't $72,000, it's $158,000. Take that by your tax rate of 25%, and your tax savings is $39,500. So 100%, bringing it back to 100%, gave this investor $21,500 in actual cash. Like actual money that they got back at their tax return that they didn't pay in throughout the year. They skipped their quarterly estimates, whatever it was, reduced their W-2 withholdings. But the difference of going back to 100% is $21,500 today. So that's money. They can take that $21,500, they can pay something down, they can put it on their next property, whatever it is. Like they can now use that much faster. So that's ultimately like what we're looking at by it going back to 100%. All right, this is before we move on, does anyone want to go in or any questions on bonus, cost segregations, anything here?
I think you summarized it well.
Everyone good? Okay. Okay, the next big topic I wanted to go over was QBI with everyone. So this is an interesting one, and it's probably the second biggest deal to some business owners, and a lot of business owners, it's the biggest deal, and to others, it's the second biggest, and real estate investors as well. But QBI deduction, what that is in 2018, when they passed the big bill, 2017, 2018, the TCJA, at that time, it was a huge deal that they took the C corporation rate from 35% to 21%. And in order to do that, there are small businesses that are C Corps, but in general, C Corps are bigger businesses. So people were like, well, what are you going to do for the smaller businesses that are typically set up as S corporations, partnerships, LLCs, and sole proprietors? And what they figured out at that time was, all right, if they meet these qualifications, we will let them take 20% off their net income, their net taxable income, and they don't have to pay tax on that. So what that's saying is if you had $100,000 of business income, if you're a realtor and you had $100,000 of bottom line income, you only would have had to pay tax on $80,000 of it. So again, it was a good thing for small businesses, but it was temporary. They only got that in through 2025. It was set to expire at the end of this year. The OB3 bill, that made this permanent. So it made it 20%, and it enlisted this as permanent. So for small business owners, that's a pretty big deal. That again, 20% is not going to be taxable. Now this, in general, you can think of this on your active business income. So this would be on your flips, on your real estate, your realtor commissions, on your property management, on whatever it is that you do day by day. If it's not W-2, this is going to be like the QBI deduction is going to go onto that. If you have an S corporation, planning around what you take as owner's compensation for QBI is huge. So if you have an S corporation or you're going to be an S corporation this year, talk to your accountant, send them an email, call them and tell them, hey, I want to make sure that I'm optimized between what I'm taking as a salary, from what I'm taking as a salary, that I'm optimized between what I'm paying in Social Security and Medicare taxes and getting the QBI deduction. So they should understand that, and they should be like, yep, let's look at it and make sure, because this, if you're an S corporation, you have to take a salary that lowers your net income on that salary. You pay self-employment taxes, but also the higher that salary, the lower your net business income, meaning the lower your QBI deduction is going to be. There's a lot of rules for the QBI deductions with phase outs. And if you make too much money, if you're in what's called a service trader business, so they treat businesses differently, like accounting firms and financial institutions, and certain businesses are treated differently for this and have even stricter rules on it and being able to meet it. So this is, it's a conversation you need to have with your accountant, or make sure you're doing right, or dig in deeper on your own. But if you can maximize that 20% that you're getting, it's a pretty big deal, and you can have some pretty massive tax savings from that on your active stuff. So think of that like your flips and realtor commissions and those. Okay. Next area I'm going to jump into here is the SALT caps and the pass-through entity credits. And this is kind of ancillary, I think, for investors and real estate professionals, but I think it's going to affect a lot of people. It affects a lot of W-2 people as well. So when the TCJA Act happened, one of the bad parts of it was that they limited the state and local tax deduction to $10,000. And so what happens is, they increased the standard deductions, and it ended up having a lot of people use the standard deduction, but they also capped the state and local tax. So what happened is, every year when you go file your tax return, you determine, am I taking the standard deduction or am I using my itemized deductions? The standard deduction for married filing joint is about $30,000. It's $15,000 for a single. So that's the standard deduction. That's the minimum that you're going to get to reduce your taxable income if you want it. Otherwise, you can add up your itemized deductions. And if those get to higher than your standard deduction, you're going to use your itemized deductions. So your itemized deductions are mortgage interest, charitable contributions, state and local and real estate property taxes are included there. And then if your medical bills are more than 7.5% of your adjusted gross income, those will start to get included. Medical bills out of pocket. The big ones tend to be mortgage interest, state and local taxes, and charitable deductions. Medical, for a lot of people, especially if they get to higher AGIs, they end up not using those a lot of times. So within that was fine. But then they said, hey, when we look at those itemized, you have to cap what you can take for your state and local taxes paid at $10,000. So if you make $200,000 on a W-2, you paid Missouri more than $10,000. You paid real estate taxes, property taxes as well, but they're only going to let you take $10,000 as a possible deduction on your federal tax return. Well, now that's increased to $40,000. So that's another huge, and it increases for inflation every year. This one phases out in like 2030. So if they don't pass something to extend this, it will go 40,000, 41,000 or so up till 2030, and then it would go back to 10,000 in 2031. So that's one to kind of keep an eye on. But again, for a lot of people, I know a lot of our clients with W-2s or with just good active businesses, this will be a huge thing for them to be able to get this and start to itemize again. It got really hard for people to itemize the last few years, so this will probably push more people back to itemizing. There are phase outs to this. They're a lot higher than typical. I think it's 500,000 that it starts at. So the phase outs start a lot higher limit on this. And the minimum you can ever take as your cap is $10,000. You can't go below 10,000 even if you make millions. So they'll give you 10,000 regardless. But for a lot of people, you can get up to the 40 now. The other part in the way to use your state taxes is something called the pass-through entity tax credit, the PTE. In Missouri, it's called the Mow Salt Parity Credit. But this says, and this is how people got around this limit for the last 7 years. If you have a partnership or an S corporation, a pass-through business, you could set it up and you could elect to have the business pay your state taxes on your behalf. So if you had an S corp that made $100,000, you could say, hey, I want the business to pay my Missouri taxes, my 5% Missouri taxes on this. And the business would pay those taxes. You'd pay them from your business account. The business would get a federal deduction. So if your state taxes were $10,000, $20,000 on that, the business would be down from 100 to 80, which passes through to you and you pick up the 80. So that was a way around it because it reduced your federal, and then you'd figure out, oh, my Missouri taxes would have been 20,000, but my business already paid 20,000. It gave you this Mow Salt Parity credit, or if you're in a different state, the pass-through entity credit. Like it gave you that credit to offset that 20,000, so that your state taxes were not, they would only be on things other than that business income. So if you had another W-2 or your spouse had a W-2, yeah, but for yours, it was all paid through that business. So this has been extended. It is, the PTE is extended, and of the two, if you have both, if you're able to get, like, if you're like, well, I do have an active business that could do both, the PTE is still better, in my opinion. The PTE is still a better option for you to use than the SALT. It's something, the PTE is what's called an above the line deduction, and the SALT is a below the line deduction. So PTE lowers your adjusted gross income, which is good because it has waterfall effects on a lot of other things. A lot of things for tax savings are based on what your adjusted gross income are. So of the two, if you get the PTE credit, do that one first, and then use your SALT with your any other state taxes, real estate taxes, property taxes. But these two items should impact a lot of people in the bill. Some other quick items on these, if anyone has this that's pertaining to them specifically, go ahead and jump in. Otherwise, I'm going to kind of breeze through them because I don't know how many people they're going to impact. 1099 thresholds are now increased. This is good news. So if you're paying contractors and you're used to having to issue them 1099s, it has been $600. If you paid them $600 or more via cash or check for services performed and they're not an S Corp or C Corp, you have to give them a 1099. And if you don't, you can be on the hook for penalties. They can take the deduction away from you. It's kind of extreme, the consequences of it. They increased that from $600 to $2,000. So now if you have contractors, if you paid them $700, you don't need to issue them a 1099. So that's going to be a nice, like, it's going to take away a lot of the, busy work from having to do this for everyone. Like they're not going to have to issue, as business owners and real estate investors aren't going to have to issue as many of these 1099s or be on the hook for doing it if they didn't. $600, just so you guys know, like it was implemented, and this rule was implemented in 1954. That the wow. 1099s were issued to anyone that you paid $600 or more. If that was increased for inflation, it would be $8,000 today. So even the fact that they brought it up to $2,000 probably isn't where it should be, because it was really meant to give to people that you're paying significant money. And it's stayed at $600 for 80 some years now. So the fact that they brought it up at all is good news. It should really be even higher. But that's, again, that'll help a lot of people just with the headaches of as many 1099s as you have to do. R&D expensing, if you have a business that has a lot of research and development type costs. So if you're developing something, if it's software, if you're building something to sell, those types of things, there's some really good news in this bill. R&D, a lot of, like, historically, and it was coming back that you would have to amortize that over time. They're now allowing for expensing of a lot of that. So R&D expensing is a big thing. This is called Section 174 if anyone wants to dig deeper into it. But this is really good for businesses that have that R&D, that are constantly, if you're in a business where you're taking something, manipulating it, trying to improve it, that could be another thing. So, we had like a dental client who he gets products and he kind of tries to adjust them and put his own spin on them and things like that. So he's digging into the R&D credits a little bit more now, that you can have R&D expensing and the credits are back for that. If that pertains to anyone, feel free to jump in on it, but it's a big thing, but I don't know how many people it will impact on this call. Vehicle interest deduction, this is new. I don't think this has ever, it hasn't been there since I've been an accountant for the last 14 years. This is for any vehicle, personal or business. Again, this is one of the campaign promises, so it's 2025 to 2028. Anyone can get it. You have to be the original owner of the vehicle, and it has to be the original loan. The vehicle has to be purchased between 2025 and 2028. It goes away after 2028. So if you're in the market and you're going to be getting a vehicle within that time frame, you will now get up to a $10,000 deduction each year for the interest you pay on that. It has to be the final assembly must occur in the US. And the original owner, original loan, for the most part means it's a newer vehicle. So those you can refinance a loan if you were the original owner on that and get that interest as well on it. But this is good. This is another called below the line deduction. So it's not affected by itemized deductions or standard deduction or anything like that. But it's there for a few years. So if you're in the market for a car and you've got to finance it the next few years, it at least starts to become the interest rates and stuff start to become a little bit easier that you get the tax deduction for those. Any questions so far on any of these items or the other stuff that we've covered?
So Jill asked in the chat, is the above the line or below the line deductions for the vehicle?
The vehicle is below the line. So the vehicle will not reduce. So Jill, because I know Jill from Cool Books, right? So I know she's got some insight to this. So Jill, you've got, so with below the line, Jill, QB, these things like the tips, the overtime, the vehicle deductions, they are all going to go in the same area of the tax return where the QBI deduction goes. So there's likely going to be a new schedule on your 1040 tax returns to break all these out. So if you're used to looking at a tax return, you'll notice towards the bottom of page 1, just before taxable income, they give you the QBI deduction. That's where all these things are now going to go, which means they're probably going to create a new schedule to just flow one line up to your page 1. So that's where these below the line deductions are going to start to go. Probably going to be a new schedule, but again, what that's getting at is things like the vehicle interest, things like the tip deduction, the OT deduction, like those aren't going to decrease your adjusted gross income. They will decrease your taxable income. So good for taxes, but when you reduce adjusted gross income, that typically has benefits to things outside of just that direct tax impact. So that typically is waterfall effects to other credits, deductions, incentives. Oftentimes, things like your college aid and stuff like that, a lot of things go off your AGI. So it's below the line.
Greg asked if the vehicle interest deduction applies at all to vehicle leasing.
Not that I know of, because it's interest. So, it's on the interest. So you're actually, go ahead.
I think that was just somebody off the line talking.
Okay, so you're actually going to get a new tax form for this at the end of the year. If you pay vehicle interest on a vehicle bought between 25 and 28, you're going to get a 1098 for it, just like you get one for the mortgage interest. You're going to now get one for that vehicle interest. Sure. So if you have a lease, you're not going to get that form, and you're not going to be able to claim it because you don't, the IRS, and you don't have that form. But again, unless there's some type of specialty lease where it's got interest built onto it, it's really just on the interest that you're paying on these vehicles. So yeah, it's going to make that decision of like leasing, financing, buying outright, it's going to add kind of a twist to that decision. And again, the leasing and the vehicle interest, all of that, if you have it in a business, there's a business owner, like that doesn't change, other than you can use it one place or the other. Like if you have vehicle personal use, you can use that on the personal. Your business use, you can use on the business. But overall, if you're leasing through a business, you still can get the same deductions through the business. You just got to make sure you're using the vehicle in the business, and you're recording and documenting your personal time and accounting for that properly. Any other questions? I don't have the chat brought up, so if there's any
I have a quick question. The 1099 threshold, when does that start?
Good question. Give me a second and let me see if I've got that in my notes here. It is after 2025. So 2025 is going to be the $600 again, and then 2026 it's going to start with $2,000.
Got it.
That makes so in January of 25, you're gonna need all the 1099s again for $600. Call Jill. I think Jill does 1099s, I'm assuming, but if you have a pain with it, call her, have your accountant do it, or bookkeepers do the 1099s, but then they will go up to $2,000 after that. On the 1099 stuff, I'll tell you that if you, for all of our clients, we coach them like, just make a habit of any new person you bring on, W-9s filled out, W-9s filled out, W-9s filled out. Like, get a system in place, use your accountant, use your bookkeeper, but have that W-9. That's gonna make it a ton easier on you. Like, they're not hard if you do the system correctly, but it's just a pain. And if you don't do it correctly and get those, it becomes a huge pain in the neck in January. But yeah, 2025 at $600, 2026 it goes up to $2,000, and then they're not adjusting this for inflation, like within the bill.
Anybody else got questions? Just jump in.
Good. I can run through the other if there's any kind of topics on this. So the other ones, let me go back to sharing my screen here for a sec, just so everyone can see. The other ones on this, and again, feel free, I'm going to kind of skim over these. So if there's something you want that pertains to someone in particular and you want to go deeper into, I think we got about 15 minutes or so left. So no tax on overtime and tips. Let's start with tips. So for tips, it's up to, if you're filing the tax return as single, it's $12,500. If you're filing it as married filing joint, it's $25,000. And so, well, let me tell you that. One sec. I say that overtime and tips, I want to get them right because one is 25,000 no matter what. The other one is 12,500 and then 5,000. So overtime is 12,500, 25. Okay, so tips is 25,000 no matter what. So if you're filing single, married filing jointly, you can get up to 25,000 of your tips that are deductible. Again, this is a below the line, so it's going to go by where your QBI goes. Some big items to note here. This isn't going to be like I've seen a lot on it, like, well, I'm just going to bill someone $1 for their tax return and $10,000 for the tip. This isn't going to be like a free for all. They're coming out with more and more on it. So what they're saying is it has to be historically, the industry that the tips are in, there's a few things. They has to be an industry that pre-2025 historically received tips. It was customary that tips were received. The tip has to be completely voluntary from the payer. So things like automatic gratuity at restaurants does not count. The 18% automatic gratuity stuff, if there's a requirement on there to pay it, it will not count. It has to be at the voluntary of the payer. It's got to be reported on your W-2. So W-2s for tipped employees are going to start to look a little differently. Same for overtime employees. Like, it has to be broken out and reported on your W-2 in order for you to claim it. So if you make cash tips of $30,000 and you don't turn those in or claim them anywhere, you can't take the deduction. Even if you do claim them as income, you still can't take the deduction unless you have a W-2 or some type of tax info that is reporting these tips. A big question that I have and that other accounts have had, so they'll have to get more clarity on this, is let's say I'm an Uber driver and I just run a sole proprietorship, an LLC that I'm driving for Uber, or if you're doing food runs, whatever it is. If I make $30,000 in tips and I don't take a W-2 because I'm not an S corp, how do I report that? How do I file a tax information form to tell them that? And so we're going to have to wait to see what they say on that. But if you're a self-employed person, you're going to have to kind of wait and see what they say. They're going to release a list. The Treasury is going to release a list of businesses that qualify, or industries that qualify. And I would assume within that, there's going to be some pushback. And does this industry qualify? Does this industry qualify? And some court cases that come up. But any questions on how the tip stuff's going to work? The next one on here is overtime. So for overtime, it is up to 12,500 if you're filing single, up to 25,000 if you're married filing joint. Now, it doesn't matter if you're married filing joint and one spouse works all the overtime, that's fine. It's still $25,000. So again, the deduction is up to $25,000. On both tips and overtime, there's some phase outs. So I think for tips, it starts at 150 and 300. Single versus married filing joint. If your AGI is above that, then it starts to go down. I think for overtime, it's 200 and 400, I want to say. Don't quote me on those amounts, but those are, look into them if you want to know the exact, but those are they start to phase out if you make too much money. With overtime, the big items on this, it must be reported on your W-2. So the overtime pay has to be separately reported. Again, this should all, if you're working for someone, this should all happen. The payroll company should get updated W-2s to report this kind of stuff. But on the overtime, it's the half of time and a half. So if I make $10 an hour and my time and a half is $15, $5 is what's my overtime deduction. So it's not all 15, it's the $5. So those are the big items on the overtime pay. And again, it's 2025 through 2028, and then that one's set to go away. Questions on the overtime or anything with that? Good. Trump accounts. If you're gonna have a kid between 2025 to 2028, these are pretty good. If you have a kid between 25 and 28, the government will automatically put $1,000 into this Trump savings plan for them. It's invested, it grows. You can put up to $5,000 a year in that account, and it grows tax free, and then it can be used for all sorts of things. I think it's once they turn 18, education, savings accounts, things, or education, it can be converted to IRAs, it can be left in there. But even if they just left the $1,000 in there for 65 years of their life, the growth on that's going to be pretty good for them. They haven't yet said if I'm guessing there's going to be a penalty, because they really say with these Trump accounts that they work similar to the IRA rules. So I have a feeling that if you try to pull the money out sooner, you're going to pay a penalty. But if you're having a kid in this, you might as well get the free $1,000, and then if you can contribute to it, still a decent account to contribute to for savings and retirement, education, things like that. I think first-time home buyer goes on there. There's some other things that are going to go on there as well for them.
Is that automatic, or do you got to do something to get that?
They haven't said. I mean, they've made it seem like it's going to be automatic, but I don't know.
So every kid born in the next 4 years automatically gets this $1,000 account?
Yep. Yeah. So they've made it seem like it's going to be automatic. Now, a couple of things. I'm guessing it's kind of like the automatic to the extent that you've filed tax returns and they have you on file and things like that, kind of like the stimulus payments a few years back. But so far, if there is going to be something else to do or to sign on for, like, they haven't rolled it out yet. So if they do roll that out, I have a feeling it'll be something that somehow they make you notified if and when you have a kid that you get this. But yeah, if you have a kid between January 1st, 25 to 12/31/28, sign up and get the account to, again, get the $1,000 and then get, have the ability to contribute another $5,000 if you want to on top of that. Charitable deductions became a little bit more advantageous. If anyone remembers during COVID times, typically charitable deductions, you only take them if they're itemized deductions. If you use the standard, that $30,000 we talked about, you don't use charitable. During COVID time, they actually made for a couple years that you could get $300 or $600 of your charitable deductions, even if you use the standard. So you could get the 30,000 standard and then the 600 charitable. They brought that back. So now it's $2,000 and it's permanent. So if you contribute up to $2,000, even if you're using the standard deduction, you can still get up to $2,000 of charitable deductions, cash or non-cash. So that's good. It's got to be a qualified charity, qualified public charity. It can't just be like the lemonade stand that you decided to give money for, but it does have to be qualified. They made a weird rule with this one as it pertains to the itemized deductions. If you're itemizing instead, they're actually saying if your charitable deductions are less than 0.5% of your AGI, you can't take them. So it's kind of a weird rule. I don't think it'll affect a ton of people, but that's kind of an ancillary rule they got in with this one. The other part here that is should help a lot of people, or at least I would tell people to look into. They've enhanced health savings accounts. So health savings accounts are probably the of any IRA, Roth, whatever it is, health savings accounts have the most overall tax benefits, because you put money in, it's deductible from tax. It grows deductible. You take it out as long as it's qualified for medical. You don't have to pay tax on it. So they get all around tax benefits, whereas IRAs, you either get the tax deduction when you put it in. If it's a Roth, you don't get a tax deduction when you put it in, but it grows tax free, and you don't have to pay tax on it when you take it out. For HSAs, they get the best of both worlds. So they've enhanced those. Generally, to do a health savings account, you had to have a high deductible health insurance plan. That's still generally it, but they've added some additional accounts that can qualify there. There's like a bronze and a casualty type plan on the health marketplace that now qualify. They've started to include some other account types on there. So look into those if it's something you think might happen. One that I know I look into all the time, because a lot of our clients use this. A lot of our small business clients use things like kind of like the Christian care type things, so they don't have to pay a fortune for insurance. Those still don't qualify you to contribute to a health savings account, unfortunately. I'm hopeful we'll get those through at some point, because a lot of people use those to not pay as much health insurance and to still get what they need for benefits. But they don't have those. They've also enhanced things that you can use your health savings account money for. A lot more wellness things are now going through there and stuff like that. So again, I'm going to do some more kind of webinars. I'll put them out there when I do them. If anyone wants to jump on those, in each of those, I'll probably kind of pick the big ones, and then I'll pick a handful of these to deeper dive into. So if there's any of these types of things or anything else within the bill that you start to see, we'll probably cover that in some more of these. I wanted this one to be geared mostly towards the stuff that's going to affect the mass of everyone on the call, and then these others kind of make you guys aware of, look into, talk about with your accountant, bring them up so that you kind of make sure you're getting the bulk of these deductions in 2025 and then in the future years. So yeah, I think that's all I had to cover as far as this call goes. So if there's any questions on that or any other things in the bill that you guys are like, I saw this, is this true? There's a lot of misinformation going around about the bill. Most of it, even if you chat GPT it, like I'm a fan of chat GPT, I'm a fan of AI. I think it's use it in coordination with your own understanding type of a thing. And so the problem is this bill bounced back and forth between the House and Senate several times, and there was reconciliation. So there was several different versions of this bill. The House wanted to get stuff in, and the Senate took it away, and they wanted to get stuff in. So what I'm telling you here, this has all come from the final bill, from the webinars and the things that I've been on now with certified tax educators type people. So the people that I would, trust for our education 100%. So if you are doing your own research, just kind of be wary of that, especially if it's like, and I say this, like we try to post some things, but especially if it's like social media posts, like definitely do your due diligence to make sure it's either right. I usually tell our clients, like, go out there, find all that information, do it, and then bring it to us, and we can tell you yes or no. If we need to research it more, we will. So that's the kind of level that I would do with it, is like, take it, dig more into it, find out more information about it, but just be kind of aware. Don't take everything you see on it like that it's gold or that it's the actual, because I've seen a lot of wrong information on it. And again, some of it's minor, some of it's big. So let me know if there's anything like that you guys are like, well, I saw that, did that stay or not? But any questions or anything like that you guys have?
Can you stop the screen share, Peyton?
This.
Great presentation, man. Awesome information. I got a question that's not 100% related, but it's sort of related. Have you heard that the state of Missouri had eliminated the capital gains tax for the state?
Yeah, they are supposed to be. I can send a confirmation of it. I think that's gone through now. I believe they've done it. So again, that's a pretty big deal, because that's, if you do have capital gains tax, you sell your property, let's say you have 100,000 capital gains that Brian's talking about. Normally you're paying 0, 15, or 20% at the federal level. For most people, it's 15 or 20. If you're a high earner, you add on 3.8% to that, so it's 23. Then you add on Missouri's 4.7, so it ends up becoming 30% pretty fast. But Missouri is, I'll say this with a grain of salt. Like if it's not passed, it's like 99.99% that it should be passed, that they're going to eliminate the capital gains tax for Missouri. So that will be nice, because if you're at a 15% federal level, that's at least you're just at the 15%. And that'll, for you guys, that should change your mentality. I try to tell people how to think of this in like their overall planning too. That should change your opinion on if, when, and how you're doing 1031 exchanges.
Yeah.
So if you're contemplating whether to do a 1031 exchange, you want to know what's my capital gains hit if I sell this now. Because if you do a 1031, you're decreasing the depreciation you can get on the new property that you invest in. So if you're at a 0 or a 15% capital gains rate, for our clients, a lot of times I'm like, just lock it in. We got the 15% rate. We'll run a cost seg on the new property. We'll get that one. But you're not going to be at a 15% rate in 5-10 years. Like so think of it like that. And especially now that the Missouri tax goes away, that goes from 19% down to 15. So that it will change that decision for a lot of people on what they can do there.
Thanks for clarifying that, and I agree. I think it makes more sense to do stop doing 1031s as long as you're buying higher dollar properties. If you're buying lower dollar properties, it doesn't make sense. But buying
Yeah.
higher dollar properties, it makes sense to not do the 1031 and just do the bonus depreciation.
Yeah. Or if you're in a high tax year where you're like, hey, I'm making significant this year, I'm going to have to pay that 20% plus the extra 3.88 net investment income tax, then start to weigh it. But if you're in a lower tax and you're getting into a bigger property, a lot of times I'm like, hey, just let's take the hit on this. We can outweigh it somewhere else if we can, and then be fully depreciating the new property.
Hey, Peyton,
Yes.
have you heard anything about, I've heard rumors that the federal government's trying to push the Section 8 down to the state or at the state level and let the states handle it individually. I don't know too much about that. Have you heard anything more about that?
I haven't. I've not. It wouldn't surprise me, just from the fact of it being a Republican, the both being Republican right now. But I have not heard that or seen anything on it.
Well, Peyton, you did an awesome job of giving us a great overview and staying right within time. I think you did an awesome job.
Yeah.
I feel like I got a better understanding of the bill, and this was really good. And if anybody just wants to, potentially look for a new CPA or at least talk about it, Peyton is awesome CPA right here in O'Fallon, Missouri. Or Lake St. Louis. I don't know. Where are you in O'Fallon or Lake St. Louis?
Technically, we're at Lake St. Louis Boulevard and 64 now, so we're just on the outskirts of Lake St. Louis here.
Lake St. Louis. So if you guys are looking for, feel free to reach out to Peyton. Did we put your information in the chat or anywhere? I guess obviously that was on that presentation somewhere, but anyway, and he's a Buyers Club vendor, so his information's all on the Buyers Club vendor website, or Buyers Club website, Buyers Club website. Anyway, thank you very much, Peyton. That was awesome. Rachel, you want to wrap us up for today?
Yeah, thanks, Peyton. That was really good and really helpful. So if anyone has follow-up questions, definitely be sure to reach out and talk to Peyton. So tomorrow we've got our Buyers Club meetup, which is going to be awesome. We've got Nick Thiel speaking. So make sure to be there. Doors open at 6 o'clock. Yeah, you're not going to want to miss this one. We're talking all about budgets and rehab projects. So, and then next week on Buyers Club Live, I don't remember what we have on the calendar, but it'll be lots of fun. So be sure to show up next Wednesday. If you guys need anything in the meantime, be sure to reach out. Peyton is one of our vendors, and it looks like we got Matt Hayes on. So if you are looking to grow your vendor team, you can always check out our website and check out the vendor team there to continue to grow that. But we will see you all tomorrow night.
Bye, guys.